Hi, and welcome to Bordertraveller Podcast episode 11. This time our hosts will talk about the EU-Mercosur Agreement that turns out to be much more than a traditional trade deal. Take it away, guys.
I have to be honest with you, when I first saw the topic for today, I kind of hesitated. I actually put the file down and went to get another coffee.
Oh, yeah. Why is that?
Because usually when we talk about trade deals, it is the absolute fastest way to lose an audience. You start throwing around terms like tariff rate quotas and people's eyes just glaze over.
Right.
It just sounds like the driest topic on earth. But then I started reading the papers you brought in, specifically this strategic analysis, the Mercosur pivot, and I realized I was completely wrong.
You were, and don't feel bad because that boredom is almost part of the design.
How do you mean?
Well, titles like the EU-Mercosur Association Agreement, they're sort of like camouflage. They sound dull, so you don't really notice that underneath all that text, there's this massive geopolitical chess move happening.
So this isn't really about trade then?
Not in the old sense, no. This is about survival.
That's a big claim. But the source material, it really backs that up. It describes the European Union as being in a, and I'm quoting here, multi-front war for resources.
Mm-hmm.
So I guess the mission for this deep dive is to figure out if this deal is a winning strategy or, maybe a desperate Hail Mary. We're looking at the text finalized back in December 2024, now moving toward ratification.
And the central conflict is that the EU is trying to create what the report calls a third pole in the global order.
Mm-hmm.
They are, frankly, terrified of being crushed between the United States and China.
And to stop that, they need friends. And they need raw materials.
Exactly.
Okay, hold on. Before we get into the whole third pole thing and the spy thriller aspects of all this, we have to understand the mechanism. We need to unpack the deal itself. On the surface, what are we actually looking at here?
Okay, so at its most basic, this is a trade liberalization deal. A huge one, actually, between the European Union and the Mercosur bloc.
And for anyone who doesn't follow South American politics, Mercosur is what? Brazil, Argentina?
Brazil, Argentina, Paraguay, and Uruguay. Those are the core members.
And Bolivia is new, right?
Yes, Bolivia is the new addition. We will definitely get to them. They are a huge wild card in this whole thing. But for now, broadly speaking, the deal removes duties on 91% of goods.
91%. Wow. That seems incredibly high.
It is. It creates this unified market of over 700 million consumers. To put that into perspective for you, right now, if a German company wants to sell a car in Brazil, they are hitting a tariff wall of 35%.
35. So a 50,000 euro car suddenly costs, nearly 70,000?
Exactly. It just makes European goods totally uncompetitive. This deal wipes that wall out. Cars, machinery, chemicals, you name it, the tariffs just disappear.
Okay, so for the European side, it's a clear win for their big industrial companies. But trade deals are two-way streets. What is Mercosur getting? Because, European farmers are famously protective.
And that has been the sticking point for 20 years. The South American nations, they get access for their agricultural goods. We're talking beef, soy, poultry.
But there has to be a catch.
There is. It's not a free-for-all. This is the crucial part. It's quota-based.
Okay, explain that. Quota-based versus totally tariff-free.
So, unlike the German cars, which get basically unlimited access, the Argentine beef gets a specific limit. Mercosur can sell, say, 99,000 tons of beef to the EU at a lower tariff.
And anything above that number.
The old high tariffs kick right back in. It's a way to open the door just enough without, bankrupting French and Irish farmers.
Right. So it sounds like a standard, I buy your cars, you buy my beef deal. It's big, but standard. But this is where I got really stuck in the reading. I was looking at the economic projections in the trend report, and I honestly thought it was a typo.
The GDP numbers.
Yes. The projected gain for the EU from this massive decades-in-the-making deal is 0.1% of GDP.
That's right.
0.1%. That's a rounding error. Why would you spend 20 years negotiating, fighting with farmers for a bump you literally wouldn't even notice on a chart?
And that right there, that's the aha moment. If you're judging this deal by GDP, you're looking at it through a 1990s lens. You're assuming the goal is profit.
That it's not.
The goal isn't profit anymore. It's what Brussels calls open strategic autonomy.
Okay, open strategic autonomy. That sounds like peak Brussels speak. Translate that for us.
It just means de-risking. It means the EU has woken up and realized that relying on Russia for gas was a disaster, and relying on China for critical minerals is a ticking time bomb.
So this deal isn't an offensive play to get rich. It's a defensive perimeter.
It's an insurance policy, a huge one. And there's another layer to it. It's about exporting values. You've heard of the Brussels effect.
Right. The idea that the EU market is so big and so rich, it can basically force other countries to adopt its rules.
Yes. And this deal has binding commitments to the Paris Agreement on climate and very strict deforestation standards.
But I have to push back a little there, because I know a lot of environmental groups have slammed this deal. They say it lacks teeth, that the enforcement is too weak to actually stop, the burning of the Amazon.
And that's a valid critique. The enforcement mechanisms are, let's say, more diplomatic than they are punitive, but you have to compare it to the alternative. If the EU walks away, who fills that void?
China.
And does Beijing care about deforestation standards in its trade deals?
Not at all.
So, yeah, it's imperfect, but it's an attempt by the EU to say, if you want access to our market, you have to play by our rules. It's a soft power play.
Which brings us to the real prize. Because if the GDP gain is tiny, what are they really after? The report calls it the green gold rush. We're talking about lithium.
The white gold. You can't have a Green Deal. You can't have an EV industry without lithium batteries. And right now, the EU is absolutely terrified because they are so late to the party.
How late are we talking?
Dangerously late.
Yeah.
China dominates the market. They control the processing, the refining, and now they're buying up the mines themselves.
And this is where that pincer movement from the report comes in.
Exactly. The EU didn't just sign one deal. They secured the so-called Lithium Triangle, Argentina, Bolivia, and Chile, through two very different, very specific diplomatic avenues.
Okay, let's break that down because the strategy is so nuanced. It's not just South America. The report makes a big deal about how they handled Chile versus, say, Argentina.
Right. It has to be country-specific. So let's start with Argentina. Argentina is a founding member of Mercosur, so this main deal we've been talking about. That gives the EU direct privileged access right there. That's one pincer.
Simple enough. But then there's Chile, and Chile is arguably more important for lithium right now.
Their industry is much more mature, yes. Chile is the world's second largest producer. But here's the trick. Chile is not a full member of Mercosur. It's an associate member.
So the main deal doesn't fully apply.
Correct. So the EU used a side door. They have a separate custom-built treaty called the Advanced Framework Agreement, or AFA. It went live in early 2025.
Okay, so that's the other tensor. The Mercosur deal gets Argentina, and the AFA gets Chile. But what about the wild card? The report calls Bolivia the newcomer with an asterisk. I love that detail. Why the asterisk?
Because Bolivia is, well, it's complicated.
How so?
So Bolivia officially became a full Mercosur member in July 2024, but becoming a member and actually integrating your economy are two very different things. They have a 4-year window to adopt all of Mercosur's trade rules.
So they're in the club, but they haven't learned the secret handshake yet.
That's a great way to put it. The EU deal doesn't fully automatically apply to them yet. The frictionless trade part is lagging behind. So the EU has what you could call political dibs on Bolivia's massive lithium reserves, but the mechanism isn't there yet.
Which seems risky. Bolivia has a history of resource nationalism, right?
Yeah.
Kicking out foreign companies.
Very risky. But they have no choice. The data in the report on this is terrifying. I was looking at a chart called the leverage gap. It shows that right now, less than 10% of Argentina's lithium goes to the EU.
And how much goes to China?
43%.
43. Almost half.
And that's just lithium. Look at soy. 69% goes to China. Iron ore, 64%. China completely dominates the feedstock of the region.
So this is a defensive move. The EU is just trying to stop a total Chinese monopoly on the batteries of the future.
Precisely. If they don't lock this in now, in 2026, then by 2030, a company like Volkswagen would be buying its batteries from Chinese-owned supply chains, no matter where the car itself is assembled.
That's a sobering thought. It completely reframes the whole idea of a trade deal.
And it brings us to the bigger picture. The report lays out 3 great powers and their strategies. I think this is crucial for you to understand, to see how the board is set.
Yes, the 3 archetypes, this was really helpful. The EU, the US, and China. Let's start with the US. The report calls them the fortress.
It's a perfect description. U.S. policy since, I'd say 2016, has been all about managed trade, protectionism.
Tariffs, walls, subsidies, the Inflation Reduction Act.
All of it. The U.S. has checked out of these big, messy trade deals. In Latin America, they're focused on security and migration, not commerce. They're building walls, both literal and economic.
So the U.S. is playing defense by just closing the gates. Then you have China, the challenger.
And in this region, they're really the incumbent. Their strategy is the Belt and Road Initiative. It's very direct. We'll build your port, we'll give you a loan for a dam, and in exchange, we get the rights to that mine.
It's cash and infrastructure.
It's owning the upstream. They want the mines. They want the ports. And they don't ask questions about your labor laws or deforestation. They just want the raw materials.
Yeah.
And it's working. Their trade with Mercosur is about $185 billion. The EU's is only $120 billion.
Okay, so China has the cash. The U.S. has the muscle.
Yeah.
What does the EU have?
The report calls them the networker.
The networker, or my favorite phrase from the analysis, resilience via regulation.
Resilience via regulation.
The EU knows it can't outspend China. It can't just write checks. And it doesn't have the military might of the U.S. So what does it have? It has the single market.
The largest, richest consumer market in the world. And it uses that as a lure. It says, you want access to our 450 million wealthy consumers? Great. Sign here. Agree to our rules. Join our network.
So it's building a blue block of democracies and partners.
Exactly. It's trying to bind countries like Brazil to the West, not through military alliances, but through bureaucratic, binding legal standards. It's a complete evolution from where they were 20 years ago.
Right. They traced the phases. Phase one was just trade for profit.
The old global Europe idea from the 2000s, just lower tariffs and sell more stuff. But then the world got scary.
2016. Brexit, Trump.
Exactly. So we entered phase two, normative power and friendshoring.
Friendshoring. That's a bit of a buzzword, but what does it actually mean here?
It means you prioritize trading with people you trust, or at least people you can legally bind to a contract. You move supply chains away from adversaries and toward allies. This Mercosur deal is the ultimate expression of that. It is trade for security.
Okay, so this brings us to the takeaway for the listener. For the EU, it's about survival. But what about for Brazil or Argentina? Why are they signing up for this? Why jump through all these European hoops?
Especially when China is standing right there with a blank check.
Right.
Because they're afraid, too. The South American nations are not signing this because they love European bureaucracy. They're signing it because they're terrified of becoming a vassal state of China.
The so-called debt trap diplomacy.
Exactly. They want options. They want a counterweight. By signing with the EU, they can play Europe off against China and China off against the U.S. It gives them agency.
It's not about picking a side. It's about having more than one door out of the room. So I want to bring this back home. We've talked geopolitics, but how does this actually affect the person listening to this right now?
Well, it fundamentally affects the technology they use every single day. We've been living in an era of homogeneity, right? A globalized world where a part made in China, assembled in Mexico, and sold in Germany was just normal.
And that era is ending.
It's over. We are now entering an era of competing operating systems.
Like iOS versus Android, but for the global economy.
A perfect analogy. You'll have the U.S. operating system walled off, high-tech, the Chinese operating system state-run and resource-hungry, and the European one rules-based and regulated.
So the electric car I buy in 2030.
The EV you buy in 2030, the smartphone in your pocket, whether that device even exists, what it costs, and whether it's built with sustainable materials. All of that depends on whether this specific, very boring, very bureaucratic deal actually works.
Because it determines who controls the inputs.
It all comes down to who controls the lithium and the cobalt. If this deal falls apart, those inputs go to the Chinese operating system, and the Western consumer market loses access to the ground floor of the next industrial revolution.
It is incredible that the battery in your next car is being decided by a clause about Bolivian integration timelines.
That's the butterfly effect of geopolitics in 2026.
So to wrap up, on paper, this whole thing is a 0.1% GDP gain for Europe, a tiny blip.
But in reality, it's a survival strategy. It's the EU trying to be the last guardian of free trade in a world that has turned against it.
And it's a huge bet.
It's the biggest bet Europe has made in a generation.
Yeah, I guess I want to leave you with this final thought, something that's been nagging at me. The EU is betting everything on the idea that regulation and standards can beat cash and infrastructure from China and tariffs and walls from the U.S.
It's the ultimate test of soft power.
Exactly. In a world that seems to be governed more and more by raw power, by who has the biggest navy or the biggest bank account, is a stack of paper really enough? Is a contract strong enough to secure the resources of the future? Or is the EU bringing a contract to a knife fight?
That's the question that 2026 is going to answer.
And we will be watching. Thanks for diving deep with us. We'll see you on the next one.